Recession is here as a new indicator is sounding the alarms and as President Trump warns of more pain to come. Pain that as a country we need to go through together, which is, again, deflation. Now, it's been a long time coming as the government deficit spending has continued to kick the recessionary can down the road. Now, a question I keep asking myself over and over again, and I think it's a really important question, will President Trump bail out the banks? So it's going to be important to pay attention and watch because we need to hope he does not. Now, today, the ADP numbers came out and completely upset the market as it missed expectations by about half, with the private sector adding only 77,000 jobs. Now, on today's housing market segment, we're going to go over the mortgage rates absolutely plummeting, and we're going to try to decide whether or not now is finally a good time to buy, despite the math saying it's actually the worst time to buy. But before we go into all of that, I wanted to give a quick congratulations to our co-host, Mitch Vexler, with Zero Hedge, as Mitch Vexler has been on Zero Hedge once again. As you guys can see here, fraud on a mass scale, why President Trump should repeal real estate taxes. Mitch, can you break this down?
Yes. So everything that's in that article, and the article's fairly long, and thank you to Zero Hedge for publishing an article that I know is abnormally long. But what's in there is what many of these viewers that are on this channel know as the median household income. And it's breaking it down and explaining why what has been done to them is a straight up fraud. And this is kind of the forerunner to what just got filed last night with the DOJ, which is a full-blown criminal complaint. So that's what's in this memo, and this is walking the math through that process, and it shows the intertwine of all these different government entities that ends up in reality equity stripping mom and pop. It's a great article, and it is the forerunner to the full criminal complaint.
I love how you mentioned, Mitch, that the viewers of this channel should already have that information, but it's so refreshing to see how companies are starting to pick up and pay attention to what it is you're talking about. They're starting to look at the math, and they're starting to warn the public of what's really going on. Now, I want to start this video, Mitch, by going into the new recessionary indicator that is sounding the alarm on the fact that we're probably already in recession. Take a look. When I went to the Federal Reserve Bank of Atlanta and I looked at GDP now, it's showing the new estimate is negative 2.8%. This is a huge deal. Again, Atlanta GDP is suggesting we're going to go negative the first quarter of 2025, not by a little bit, but by a lot, 2.8%. Let me read a little bit about this. GDP now is not an official forecast of the Atlanta Fed. Rather, it is best viewed as a running estimate of real GDP growth based on available economic data for the current measured quarter. And it's not official because they need to damper down the truth. They need to manipulate the truth first. And then once the truth is manipulated, then it becomes official. There are no subjective adjustments made to GDP now. The estimate is based solely on mathematical results of the model. Interesting. In particular, it does not capture the impact of COVID-19 and social mobility beyond their impact on GDP, source data, and relevant economic reports that have already been released. It does not anticipate their impact on forthcoming economic reports beyond the standard internal dynamics of the model, and also mentions nothing about something that's really important called median household income. As you guys can see here by taking a look at this chart, this is absolutely dropped off the face of the planet. Less than 2 months into President Trump's election, and we're starting to get to the bottom of this whole inflationary, recessionary thing. But regardless, look at that drop right there, you guys. Atlanta Fed GDP now estimate is in the absolute gutter. Mitch, I'm going to get back to you on that set of data here in a minute, but let's unpack this article that just came out today from MarketWatch titled, "Is the White House Trying to Engineer a Recession?" This Wall Street Pro explains the vision. Traders are starting to price in the possibility that the U.S. economy might fall into a recession, and one Wall Street veteran says that's exactly the Trump administration's plan. He said that President Donald Trump and his administration need an engineered recession. Listen to this, guys. Pay attention to what this guy is saying. I'm going to start from the beginning now. He said President Trump and his administration need an engineered recession, and here it is, to cause a growth slowdown and the big word here, disinflation. that will translate into Fed cuts and a meaningful weaker US dollar for that next phase of his economic agenda. So if anyone wants to buy a house, let me just tell you right now, you're going to have price decline at the same time as you have interest rate decline, like I've been telling you guys for the last 1.5 to 2 years. Again, you're going to have in the housing market price decline at the same time that you have rate decline. In another note to clients on Wednesday morning, they cited remarks made by Treasury Secretary Scott Bessent on a focus on small businesses and consumers that will require another keyword, trigger word here, rebalance. Anytime they use the word rebalance, that means wealth gap change, and someone's going to get hurt. As Trump in front of Congress on Tuesday night spoke on being okay with a little disturbance from tariffs. On the betting market, Polymarket, a 37% chance of a U.S. recession this year is now priced in. Very interesting. Rate cut expectations are increasing as the U.S. dollar has dropped 4% from its highs that were in early January. Markets have been unsettled this week by Trump's imposition on tariffs. Surveys of both companies and consumers turned sharply lower. On the crypto betting market, Polymarket traders are pricing in a 30% chance of a U.S. recession this year. Now, I want to remind you guys on why I believe we haven't gone into recession yet. One big reason is what you see right here. This is just the yearly government deficit. The total deficit is like 37 trillion. This is just what it is so far this year, sitting at an unprecedented 839 billion. And this has been happening for the last 4 years. So this is one reason. Here's your second reason right here within this graph. This is a graph, the total assets held, okay? So this is total assets held by the Fed. And I want you guys to remember what happened in March of 2023. They made the bank term funding program and bailed out the banks. That's what this jump up right here. So the Fed said they're going to do quantitative tightening. They're selling assets, right? Getting rid of assets. But look at this. As soon as bank turmoil happened, boom. They bailed out Wall Street, they bailed out the banks, and what that did, you guys, is kick the can further down the road. In other words, you guys, don't get confused that we haven't gone into recession yet. We're not fighting a fair fight. They're hiding stuff to us because the economy needs us to be tricked. The economy needs us to spend our money to stay afloat. The economy needs us to get into debt because they have defrauded us as the public. Mitch Vexler, sir, I have my first question for you. I think everyone's starting to get we're going into recession, okay? I think everyone's starting to get that this is an everything bubble and that one of the big risks here, not one, we'll get to the housing market, but pensions and 401ks. I know we're going to take a hit. A lot of people know we're going to take a hit, but in just your opinion, you're not a financial advisor, but say the wildest things happen, depression, pensions, 401ks go down by 60%. I need you to try to figure out, Mitch, what can mom and pop do right now today? You just top of your mind. What can they do today to protect their 401ks and to protect their pensions from an incoming recession?
I think we have to take a step back here for a second. The CPI inputs, the actual data to the CPI, the requirements, the definition of the CPI is not what it once was. They keep manipulating the data. Well, if you manipulate the inputs, you cannot possibly get a truthful output. It's impossible. So when you understand that they're doing what they're doing, prior administrations, for purposes of deceiving the public, well, the ramification of that is they artificially induced things to happen. And I once said that the fraud is the only thing holding this system together, if you want to call it a system. What needs to happen is that fraud must come out of the system in order to get to the truth and create stability. When you don't have stability, you have volatility. And that leads to where you were a second ago, Travis, the pension funds. If volatility occurs, which obviously it is occurring now, because if you go look at the VIX index, it's actually spiked. So does that mean the market's not going to go back up temporarily and come back down? Either way, volatility up, volatility down. But the pensions are absolutely at risk. And that's one of the reasons why we wrote that memo, the criminal complaint to the DOJ, to lay this out as to what's happening. So if you look at the school districts that are participating, again, in the fraud, the evidence is there. We've given it to the DOJ. But those school districts that are participated in the fraud and those who sold the bonds for the school districts, they sold those bonds to mom and pop, right? They sold it to pensions. They sold it to 401ks. Either way, that's mom and pop. If you have money that's invested in that type of municipal / school district bond, you're going to have a problem. And you've got to look at it and determine how big a problem do you have. If you say, well, it's only 1 or 2% of my portfolio, if you're fortunate enough for that, you won't have a problem. But if it isn't, and you're a school teacher and they took your pension and they invested it back into the bonds of the school district, best you be aware as to what's coming your way. And the one thing to do is simply not participate in that scheme. And that is exactly what we have called it with regard to the document that went to the DOJ. It is a Ponzi scheme by every definition in law. So best not to participate.
Mitch, before I go to the next question here about the deficit keeping us out of depression, say people already have the 401ks and pensions and they're a teacher and they're going to plan on retiring next year, let's say. Do these people have the possibility, and I know they have to really think about this is so important, but do they have the possibility to reallocate some of those 401k funds? Like if I'm a 401k holder and I notice that my funds are being invested in things that I don't like, can I contact my 401k company and say, reallocate my investments into safe investments like treasuries? Is that something they could do? And is that something that you think they should do?
If somebody was concerned, they literally can go and buy treasuries direct. If you showed up to those people who are selling that, you would be a dream for them because they get to churn the portfolio. So all you're doing is putting your money into their pocket in terms of fees. If you want treasuries, you literally can buy them direct yourself. Just look it up, US Treasuries Direct. And you can do that on your own. You have to look at the entire scheme of things as to what's happening. There are banks that are at risk. Travis did that video in California. Well, that bank that's got that $300 million, they got a problem. So these things all stack. And my point of all of this, you must know where your money is. Even though I'm no fan of any of these schools that have been hiding the investment pools from the public, the school districts, those investment pools more than likely contain teachers' pensions. Well, they put those pensions at risk by virtue of no bond schedule, no sources and uses to the balance sheet. All these problems that are there under the hood, again, that we delivered to the DOJ, those pensions are at risk. There's some serious things going on here. And when I say don't participate, it's best not to participate. That's true. If you're at risk and you think this market is going down and you think your pensions are at risk, why would you stand in front of a rolling freight train? Logic says you wouldn't. And logic says, yeah, you may be better off going to US Treasuries or if you want to go into precious metals, at least you got it and it's not in a bank.
Yeah. I still got to stack up my silver, Mitch. I'm a little lagging on that. It's been hard to do going out of town because what the viewers don't know is every time I come back from town, I have an allergy attack for some reason, like I'm having it right now. I don't know if you guys can tell, but I've been practicing for 2 hours not to sneeze. Now, Mitch, another thing is we went over the government deficit. We went over the bank term funding program. What impact do you think those things had? In other words, do you think if there was no deficit spending and there was no bank term funding program, would we already be in a technical, we probably already are, but would we already be in a technical depression if it wasn't for those two things, bank term funding program, government deficit spending?
No, because if you didn't have those things, you wouldn't have the fraud, right? See, the problem here is the fraud itself. The markets have been artificially blown up. Well, when something is artificially blown up, raised up, it's going to come down. That's just the way it is because the math isn't there to support it on the way up. And that includes everything from the bonds to the stock market, whatever it happens to be. When things are artificially induced, you're actually inducing instability into the market. And when it cracks, it will jump magnified on the way down. In other words, the down run will be much harder and faster than the up run. There's a whole bunch of math behind the hood on that statement, but that's what happens. Volatility to the downside increases. Well, that's what's going to happen. And so to your point, yes, how problematic is this? Huge, but it's not the idea that the CPI says this or the CPI says that today. It's not relevant. That story from Market Watch isn't relevant. That's just more manipulation. If you can't get to the truth, you're being manipulated. And that's the point of what Market Watch is doing. Well, the CPI is down and it's under President Trump's watch, but it's been artificially induced for the last 4.5 years. So when you say these things, the CPI is a lie. It simply isn't true. They took the original definition They changed the definition for political reasons. And now the ramifications of that are, well, we lied, we pumped, we stuffed the market with more money, trillions, and now we're having problems. But if you want to not have problems for the long term, you have to eliminate the fraud. It's not an option, it's a must. If you eliminate the fraud, you create stability. And that's why I said multiple times in the last 60 days or so, there's going to be pain on this. When you realize what's gone on with these school districts, I can't give you the exact number, but I can tell you that it's between 13 cents and 30 cents on the dollar is what those bonds are worth. They're not worth any more than that because mom and pop don't have the money. The only thing that matters, and I'll keep hammering on this, is the median household income. And if that income isn't there to justify the expenses on the value of a house or to justify the theft of mom and pop's money, because you can't get blood out of a stone, which is what these school districts and these central appraisal districts are doing, well, then when they sold those bonds based on a false premise. Mom and pop don't have the money. The false premise is a fraud. That's what they've done. So the economic reality is, what could those bonds be worth given the fact that fraud is what those bonds were sold on? Mathematically speaking, somewhere between 13 cents and 30 cents on the dollar. So again, why would you expose yourself to that problem?
Well, I would say, sir, I guess fundamentals are important. I think it's really important that, I want to reiterate what you said. It's so important. What Mitch said is it's because of the deficit we're going into recession, or a big reason being, again, bank term funding program. Essentially, we wouldn't even be in this mess unless it was for the artificial inflation, the artificial market that's been created and thrown on the backs of mom and pop. I mean, we saw that during lockdowns. I mean, anyone that was an adult or even a child during lockdowns knows what life was like before lockdowns is nothing like what life is like right now. And I'm not just talking economically and financially. I'm talking about as a society of people and as a community of people. A lot of things have unraveled, except for unaffordability, Mitch, except for the things that we want to unravel. The things that we want to preserve are not being preserved. There's a handful of greedy people that are ruining it for the rest of us. Let's just get this recession over with. The recession is really going to hurt the banks anyways, the elites anyways, the people upper middle class, unless the middle class and lower class don't listen, right? And all people got to do to listen, really, and I'll move on to the next thing here, guys, but stop wastefully spending your money. When we wastefully spend our money, we're just adding to the problem. We become part of the problem. When we sit back a second, rebudget how we're spending money, stop all of these subscriptions, stop going out to eat wastefully, start being disciplined, making goals, allowing those goals to shape our approach, we start winning. We have to do those things because the way the market and society is set up, it's set up to hurt us. It's set up to profit off of our failure. So you guys, if you don't want to fail, you have to plan to get ahead. All of that to say, take a look at this report. This came out from Market Watch. This came out today. ADP says only 77,000 private jobs created in February due to hiring hesitancy. U.S. businesses created 77,000 new jobs in February, payroll company ADP said. And they signed the economy could be slowing as businesses weighed how to respond to President Donald Trump's tariffs. The increase was the smallest since last summer. Economists polled by the Wall Street Journal had forecasted a gain of 148,000 jobs, so that missed heavily. Policy uncertainty and a slowdown in consumer spending, that means that they're just loaded in debt. When they say consumer spending, know that it's not increased wages. It's just a lot of people paid off their debt during lockdowns. So what you're seeing here is people recharge their credit cards. ADP also revised 186,000 increase in the private sector employment in January, up from 183,000. ADP report does not include federal workers, interesting, but private contractors who lose jobs because of government funding cuts could eventually show up in the ADP data. So you guys should look out for that because that will happen. We are not seeing it so far. For the past year, the economy has been adding enough jobs to keep the U.S. unemployment low and stable around 4%. And let me add this as well. And by doing that and not allowing us to naturally go into recession, you have killed mom and pop and defrauded all of us. Whoever's in control, whether you're a useful idiot or did it on purpose. Yet broad restrictions among federal employees, a crackdown on immigration, and rising tariffs could put a dent in hiring and raise the jobless rate in the short run. I wanted to pull up the unemployment rate. Here's the unemployment rate right here. This is from Fred Economic Data. They're calculated unemployment rate differently. So this can all be revised, but I wanted to let you guys know, don't be fooled by that number 4% that the talking heads and the financial advisors keep using to get you to distract you from what's really going on. Now, the first thing I want to show you guys in this corrupt data set is the trajectory of unemployment is going up, and the trajectory of unemployment is going up enough to kick in so many warning indicators that we're going into recession. But what I wanted to point out is that we've had numerous recessions with a lower unemployment rate than 4%. Look at right here, 1953 was around in the 2%. Look at this right here, 1957, also in the 4%. But look at right here, 1969, 3.5%. You guys see what I'm saying? Multiple times, unemployment rate has been under 4%. Look at 3.9 in the 2000s. Also, the very last recession we had, the unemployment rate was in the mid 3%, which essentially means that things can happen very, 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 very slowly until they break all of a sudden. But Mitch Vexler, can you please let us know, can you let the viewers know, what does that information, the ADP job numbers, tell us about the labor market?
I want to go back just for 1 second. When I say that there's manipulation, that article that Travis just showed, isn't it interesting? The forecast was for 148,000 jobs. According to the ADP, it's 70,000. Well, that's 100% wrong. So if you were doing your job, how in the world could you possibly forecast something that's 100% out of kilter? Somebody is lying. And that's the point of all of this. These reports, these indicators, and all this nonsense that they're spewing is just that. It's nonsense. The only thing that matters is what they refuse to look at is the median household income. It is what mom and pop can afford. And I did not know that Travis was going to show that chart or that memo.
Second question, Mitch. I'm just going to ask this as if no one's watched you before, and calm down a little bit. Are we already in recession?
Yes. If you go back to the original definition of the CPI, we are in a recession. But even that, one must understand that it's based on the fraud, because what has happened, the market has been pumped up, and now we're in the dump phase. And the only way to stop that from happening again in the future is to get back to truth in the economy, and the truth is the median household income, not all this other nonsense that's being spewed out there by all these alleged economists that literally can't add.
Well said. I mean, you got such a great point. I mean, they keep getting it wrong. I mean, how do thousands and thousands of college, probably Ivy League educated economists keep getting it wrong? I mean, how do they do? And why don't they talk about median household income or government deficit? I mean, are they paid, do you think, to not talk about that? Like, here, you can have a job, but you can't talk about median household income. I mean, how is it that every single one refuses to talk about those things, Mitch?
Well, coincidentally, we just got a memo in this morning from somebody who applied for a job at the Denton Central Appraisal District, lo and behold. And they said, well, we're looking for young people who don't have any experience.
Right.
Oh,
right.
that's
So
right.
Yeah.
Yeah.
So they could teach them the fraud early. Very good.
Exactly. It follows exactly what Chris Luttrell said. We're just doing what we were taught. Well, my response to that was, Mr. Luttrell, if you were taught to commit murder, does that make it legal? Stand in front of a judge and say, we're doing just what we were taught? Good luck to you.
Yeah, I mean, we need to start making a difference, and we need to start not profiting off of each other's backs. I know a lot of people want to survive, and it's like this dog-eat-dog world, but we don't have to take over the world. We don't have to trample over someone else to survive. I mean, we could do this together, and a lot of us just need to rebalance our spending, rebalance our expectations, rebalance our lives. There's some great people out there, and I'm convinced of that. And in fact, I'm convinced that most people are great people. Now, let's go into the next thing, Mitch, which is the housing market update. We're going to talk about mortgage rates and how they've been plummeting recently, and then we're going to go into a few things and ask the question, should we go buy a house right now? Let's see. So when we go to Mortgage News Daily, we are sitting at today's mortgage rates at 6.7%. How about that, you guys? We're under 7%. I want to notate, though, that this is averaging conventional mortgages. Most people think conventional is best because it's a little bit harder to qualify for, but it's also a loan that can come with no mortgage insurance, or what's called PMI, as long as you have a 20% down payment. But even after you close, you can have PMI removed so long as you have enough equity. What you guys see right here, the 6.12%, remember that's FHA, which is generally a lower interest rate. And depending on someone's FICO score and down payment, the PMI, or rather in this case, MIP, which is still mortgage insurance, can actually be lower. So there is a lot of advantages in FHA, but having skin in the game is not one of them, meaning the lowest down payment is generally with FHA. However, when it comes to conventional, there are actually two programs with a lower down payment than FHA called Home Ready and Home Possible for first-time homeowners. So look out for that. 15 years sitting at 6.18, VA sitting at 6.13. Don't forget, if you guys shop your loans, this is just a roundabout idea. You guys should be able to get a half a point lower than what you're saying here. So shop your loan. Generally, a mortgage broker is going to have a better deal than a direct lender because their overhead is generally a lot lower, so they don't have to pass on a higher SRP, service release premium, to you, which affects what's called the pricing in your interest rate. In other words, what does your interest rate cost? That's called pricing. But you guys can see here, when we look at the 1 year chart here, that mortgage rates have been dropping. They've been dropping pretty nice for the last 3 weeks, going from about 7.13% all the way down to 6.7, making that about a 43 basis point drop in about 3 weeks. That's not bad. That's a pretty decent drop. When we look at the 10-year treasury, the 10-year treasury looks like it's going to end today up about 3 basis points. So going into tomorrow, expect interest rates to be about flat, and watch that 10-year treasury, because when this 10-year treasury starts coming out and we start getting data, that will tell us the trajectory of residential mortgage rates in the future. When we go to CME Fed Watch, here's what the market is thinking is going to happen with the Federal Reserve cutting the short-term interest rates, or borrowing rate, or I'm sorry, discount rate, whatever you want to call it, overnight rate, whatever it is. They're saying there's no way in heck-a-majig that they're going to cut that this March. You guys can see that right here. But I'm going to tell you guys right now, this is all BS, because if we go into a horrible economic recession, this is all going to flip overnight, and they're going to say they're going to have an emergency meeting to cut interest rates. So this is completely useless, but it is interesting to look how poorly the market performs when it comes to knowing what the Federal Reserve is going to do. When we go to May, this starts to get a little bit interesting in May, with the 61.3% chance that the market is saying we're going to have a rate cut in May, but they are banking on June. So this is flip-flopping like crazy. They're basically saying only 21% chance right here of maintaining the current interest rates, or rather the federal funds rate, where it's at. When we really dig in under the hood and look at the numbers on what does it really cost to buy a house? I mean, that's a good question, right? We get bullied all the time. Oh, you're a renter, you're making your landlord rich. But when we plug in today's rates of 6.7, and we take about the average mortgage over 30 years, we're going to look at only the interest payments. We're not even going to look at mortgage insurance. We're not even going to look at taxes. We're not even going to look at insurance, which is a big, big deal. All we're going to look at is interest. So when we calculate this, guys, it shows that we have to pay back in just interest. This is not the principal. So to pay back $324,000 in principal, we have to also on top of that pay back $428,000 in interest, meaning your real interest rate is well over 100%, because the total amount of payments back on a $324,000 loan is $752,000. So it's really important that if you're going to be a homeowner, understanding how this amortization schedules work and understanding that it is front loaded with interest. And if you want to get out from mortgage date, number one, don't refinance. Number two, makes extra monthly payments. When I put in $350 extra a month, say again, $350 extra per month going straight towards principal, let's see the impact that $350 extra a month has on this amortization schedule. You can see here that by adding $350 a month towards your principal, you turn that loan from a 30-year loan to a 20-year loan. That is astonishing, and you save $160,000 in just interest. Mitch, can you explain why paying off your mortgage completely might be the best investment Americans can make right now?
Eventually, one way or the other, these real estate taxes have got to go. Governor DeSantis came out and said he's in favor of eliminating the real estate taxes in Florida. Even our governor, Governor Abbott, has said that multiple times. Now, they haven't performed, but at least they're talking. And a lot of people across the internet are now talking. Not that they have all the information, but at least they're talking. The problem here is that you end up, even if you had lower interest rates, is that part of the truth of the economy, Or is that something, again, that's self-induced by the Federal Reserve? And speaking from firsthand experience, on my first house, I had 18% interest rates. And I had that house bought and paid for in about 24 months. So I borrowed the money. I needed the money to help get that house bought, but it was paid off in 24 months. So to your point, Travis, yes, paying off that mortgage means you own that asset. So it's not just enough to say that the real estate taxes are gone, but what that does is it gives mom and pop back their balance sheet, because you end up owning that asset from which you can retire on in 20 years based on that amortization schedule, or 30 years. The point is, it's your asset. You shouldn't have to pay for something that you bought in perpetuity in the form of a tax, of any type of tax. If you buy the asset, it's yours. End of story. You bought it once, done. You don't get taxed on it again. And that's the flaw in the system, and that's the fraud in the system. And it's so bad. This document we sent to the DOJ shows, give or take, in terms of the bond fraud, about $5 trillion. And in terms of what would happen if this is eliminated effective immediately, it would add about $1 trillion in the first 12 months to the US economy. This is the big number. This is what people should be focusing on, that they refuse to do so because you're either a fraudster participating in this and perpetuating this, or your mom and pop is getting screwed over by this.
Yeah.
That's the difference. Yeah. They have to own the asset. Mom and pop must own this asset, and it's non-negotiable.
Yep. Yeah. And Mitch, there's some mom and pops that they just are not aware of what's really, I mean, they know there's an issue, right? But like what you did with me, you helped me be able to articulate what that issue is. And what has been happening, a lot of people, their automatic reaction, because I look back, what was my automatic reaction? How are we going to pay for the schools then? And thinking about this, and it's not that hard to think about. Let's find out why don't we just find out? So let's eliminate the fraud first so we can see what's going on, right? But the thing that Mitch and I are trying to explain is, yes, we have to eliminate the fraud first to see what's going on. So let's do that. But secondly, we're also saying that eliminating the fraud may be enough alone to not have to need property taxes. Think about that. The property taxes exist to keep the fraud going. And so all of that to say this, guys, well, I want to end this video by giving you guys a call to action. If you don't own a home, go to the Real Estate Mindset Empowerment Center. There's free material, free courses, free stuff for you guys to learn how to navigate this very, very toxic housing market. So please take that stuff, you guys. The link is in the description. At the end of this video, you'll also see the link. It is absolutely free. We also plan on doing seminars. Now, another call of action, if you already own a home, you guys got to jump on board with signing the petition that Mitch has made. You guys got to jump on board with the criminal complaint, which we'll be going into in great detail in the weeks to come. And you got to take the course that we made called End Property Tax. It is a free course full of all of the forms that we've been creating. Mitch especially has been creating over the last 6 months. It's all there in one location. We've made the course. It is yours for free, but we need your help. Please take it seriously. File your complaints and like the video, comment on the video, share the video. Don't forget us, you guys. Give us some shout outs. Make sure everyone is getting this information. And if you guys are out there just investing in your life, investing in real estate, or even the stock market, you guys already know we wish you luck and we hope you win.